Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's market commentary will encompass the pound-dollar market and breaking down the technical reaction to the pound volatile trading session observed over the past few days. Also, we will also break down Janet Yellen testimony in Washington yesterday. If you're trading the pound-dollar pair, I hope this commentary will fall in line with your trading strategy and help enhance the successful trade. First in line with this discussion, we're going to look at the pound-dollar cross on the technical front. Here we have the pound-dollar pair on an hourly time interval chart. The past few days have proven to be relatively volatile for the pound-dollar market, with the pound sliding against the greenback on the better-than-expected U.S. home sale number. The beginning of yesterday's trading session have allowed the sterling to retrace almost all of its losses, with lower highs before sliding once again against the greenback on an upbeat U.S. core durable goods numbers. In the later part of yesterday's trading session, despite Janet Yellen's reiterating to the market her commitment to the continuity of tapering, the dollar bullish momentum reversed course, allowing the pound to bounce back significantly. The SSI, which is the speculative sentiment index on the pound sterling, indicates that the retail traders have been piling onto their most short pound positions, with extreme reading of a ratio of approximately 8 sterling short position for every 1 long pound positions. However, that sentiment extreme has subsequently retreated to a level of 4 short sterling positions for every 1 long positions taken by retail traders. Extreme position behavior exhibits by retail traders often can be used as a gauge as near-term top is approaching. Analysts are calling for a further pound weakness if this reversal break below the 1.6628 key support level. Analysis of a collection of technical indicators on the hourly time interval on the pound-dollar market suggests a temporary bullish market sentiment and recommend short positions on the greenback. The hourly chart established short-term Fibonacci at 1.6695 and Fibonacci support at 1.6679. The pound-dollar market opens today's city trading session in the congestion after yesterday's bullish momentum lost traction. This buying pressure was exhausted, possibly due to the retail traders waiting on the sideline ahead of Friday's major risk event, which is the Bank of England Governor Carney announcement on the monetary policy. In accordance to the hourly chart, the pair trade above the 5, 10, 20, and 30-day simple moving averages. These short-term simple moving averages themselves indicate that based on the short-term simple moving average alone, the bullish momentum still remains intact. Adding to that bullish conviction, the long-term bullish outlook on the pound also remains intact as the pair trade above the 200-day simple moving average. This trend tends to hold great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data. On close examine of this pound-dollar technical chart, we have the ISI. ISI is a momentum oscillator. It shows us the potential direction of this cross. And over the past week, we can see that the pound sterling have been trading in a narrow trading range, as the ISI is sitting roughly around the 50 level, which is the neutral undertone. Moving down one notch, we have the CCI. The CCI is a commodity channel index, which is an indication of buy or sell signal. Between 0 and 100 is indicative of a buy signal, and right now, sterling buy signal has still remained intact. Now, it's time to closely touch base on the hourly time interval technical indicators. Here we have 10. The overall consensus, lightly, we will touch on that we have 5 buys, 1 sell for neutral with overall technical consensus of a buy. Moving along, we're going to explore the fundamental front on the pound-dollar market. Breaking down yesterday's Janet Yellen testimony to Congress in Washington, D.C., the chairman herself acknowledged that the string of disappointing U.S. leading economic indicators released in the month of February had been consistently disappointing, and she later raised her concern on how much that disappointment can be attributed to bad weather. Nevertheless, she did reiterate to the market her commitment to monitoring the progress of this recovery. Her remark wasn't anything out of the line of expectation, as the market didn't anticipate any major monetary changes during this particular testimony. However, it did provide the support to sterling selling pressure and revise momentum, allowing the pound to retrace all of its losses against the greenback during yesterday's trading session. Also, one other contributing factor to dollar weakness during yesterday's trading session was the jobless claim report released by the Department of Labor. The number of labor force participants whom filed for unemployment assistance rose 14K, higher than the forecast of only 1,000 claims, adding to this week's reading of 348,000 unemployment claim. The dollar weakening during yesterday, Janet Yellen's testimony wasn't about what she said, but the absence of the language she uses had the market switching back to risk appetite. Yellen did acknowledge that the string of disappointing U.S. data had been due to the weather. However, she did not openly say that the economy will rebound once the weather improved. This absence of this remark alone had traders speculating a stall or a slowdown of the pace of tapering. She gave the market a glimpse into the time frame of QE tapering through suggesting it would come into a full completion in the fall of 2014. Over in the UK, this week had been relatively quiet on the economic front from the UK, with only one major risk event that was released, and that was the UK GDP report that showed the economy expanded less than the expectation, showing a reading of 2.7% below a forecast of 2.8% year-on-year. The dovish member of the Bank of England Monetary Policy Committee, Miles and Dale, openly supported the current monetary policy that the Bank of England have implemented and reiterated the market that in the case of a rate hike, it must be done at a gradual pace, coupled with the high expectation that the UK benchmark rate would be kept below the 5% threshold. In the case that the UK economic release continued to deliver a consistent upbeat report, then it will only reinforce the expectation that the Bank of England will ultimately hike rate in the later part of 2014, if not the beginning of 2015. This expectation is what underlined the bullish bias on the pound over the past year. It is all about relative monetary policy between the Bank of England and the Federal Reserve. Thank you everybody for your time, and have a happy and successful trading.